Ever wondered what happens to your hard-earned money sitting in a bank if something unexpected occurs? It's a thought that might cross your mind late at night, right? The financial world can sometimes feel a little, well, uncertain. And that's perfectly normal. We work hard for our money, and knowing it's safe and sound is a top priority for just about everyone. Think about it for a second. You've chosen a bank, maybe an online one like Ally Bank, drawn in by their rates or their user-friendly platform. You diligently deposit your paycheck, build up your savings, and manage your finances. But in the back of your mind, that little question might linger: what if? What if the bank faces difficulties? What safeguards are in place to protect your funds? This isn't about fearmongering or predicting doom and gloom. It's about understanding the system that's designed to give you peace of mind. It's about knowing the rules of the game, so to speak, when it comes to your financial security. And that's precisely what we're diving into today. We're going to unravel the often talked about, yet sometimes misunderstood, concept of FDIC insurance, specifically in the context of Ally Bank. So, grab a seat, get comfortable, and let's demystify this crucial aspect of banking. By the end of this video, you'll have a clear understanding of what FDIC insurance is, how it protects your money at Ally Bank, and why it's such a significant layer of security in the financial landscape. First things first, let's tackle the big question: what exactly is FDIC insurance? The acronym itself stands for the Federal Deposit Insurance Corporation. Think of the FDIC as an independent agency of the U.S. government. Its primary mission? To maintain stability and public confidence in the nation's financial system. And one of the key ways it achieves this is by insuring deposits held in member banks and savings associations. Essentially, FDIC insurance acts as a safety net for your deposits. If an FDIC-insured bank fails, the FDIC steps in to protect your insured funds, up to a certain limit. This means that even if the unexpected happens to the bank itself, you, as a depositor, are shielded from losing your insured money. Now, let's bring Ally Bank into the picture. Ally Bank is indeed an FDIC-insured bank. This is a crucial piece of information. It means that the deposits you hold with Ally Bank are protected by this federal insurance. This coverage extends to a variety of deposit products offered by Ally Bank, including checking accounts, savings accounts, money market accounts, and certificates of deposit, CDs. So, how does this protection actually work in practice? Let's break down the key aspects. The standard insurance amount is currently $250,000 per depositor, per insured bank, for each account ownership category. That's a significant level of protection for the vast majority of individuals and families. The phrase per depositor, per insured bank is important here. It means that if you have accounts at two different FDIC-insured banks, you have $250,000 in coverage at each bank. Since Ally Bank is a single insured bank, all your eligible deposits held directly at Ally Bank are aggregated for the purposes of this $250,000 limit. The per-account ownership category part is where things can get a little more nuanced, but it also presents opportunities for even greater coverage. The FDIC recognizes different ways you can own your accounts, and each ownership category has its own $250,000 insurance limit. Some common ownership categories include: single ownership, accounts held in your name alone are insured up to $250,000 in total. Joint accounts, accounts owned by two or more people are insured up to $250,000 per co-owner. So, a joint account with two owners could have up to $500,000 in FDIC insurance coverage. Certain retirement accounts, like IRAs, individual retirement accounts, and self-directed 401(k)s, have their own separate coverage of up to $250,000 per depositor. Revocable trust accounts, funds held in a revocable trust can be insured based on the number of beneficiaries and their interests in the trust, potentially allowing for coverage exceeding $250,000. Irrevocable trust accounts, these have their own specific rules for determining coverage, which can be more complex. Corporation, partnership, and unincorporated association accounts, these types of accounts also have their own distinct coverage rules. Understanding these different ownership categories is key to maximizing your FDIC insurance coverage. For example, a family with a checking account in joint ownership, individual savings accounts for each spouse, and potentially a revocable trust could have significantly more than $250,000 in total FDIC insurance coverage at Ally Bank. Now, let's talk about what types of deposits are actually covered by FDIC insurance at Ally Bank. As mentioned earlier, this includes your standard checking accounts, savings accounts, money market accounts, and CDs. These are considered deposit accounts. However, it's equally important to understand what is not covered by FDIC insurance. This typically includes mutual funds. Investments in mutual funds, even if purchased through a bank, are not FDIC insured. Their value fluctuates with the market and are subject to investment risk. Stocks and bonds. Similar to mutual funds, stocks and bonds held in brokerage accounts are not insured by the FDIC. Life insurance policies. The cash value and death benefit of life insurance policies are not FDIC insured. Annuities. Fixed or variable annuities are insurance products, not bank deposits, and therefore are not FDIC insured. Cryptocurrencies. Digital currencies like Bitcoin or Ethereum are not insured by the FDIC. U.S. Treasury bills, bonds, and notes. While these are backed by the full faith and credit of the U.S. government, they are not FDIC insured because they are not deposits held at a bank. Safe deposit boxes and their contents. The physical contents of a safe deposit box are not insured by the FDIC. You would typically need separate insurance for valuable items stored in a safe deposit box. It's crucial to differentiate between products offered by a bank and products insured by the FDIC. Just because you purchase something through Ally Bank doesn't automatically mean it's FDIC insured. Always clarify the nature of the product, especially when it comes to investments. So, how does the FDIC actually protect you if an insured bank like Ally Bank were to fail? While bank failures are relatively rare, they do happen. In such a scenario, the FDIC has a few primary methods for protecting depositors. Payoff. The FDIC can directly pay depositors the insured amount of their deposits, up to the coverage limit. This usually happens relatively quickly after a bank failure. The FDIC will typically mail a check or provide access to funds through a temporary bridge bank. Purchase and assumption. The FDIC can find a healthy bank to purchase the failed bank and assume its deposits. In this case, depositors automatically become customers of the new bank with the same level of FDIC insurance coverage. This method is often seamless for depositors. The goal of the FDIC is to resolve bank failures in a way that minimizes disruption to depositors and maintains confidence in the banking system. The track record in this regard is strong. Since the FDIC was established in 1933, no depositor has lost a single penny of insured funds. With that said, thanks for watching, and until next time.